Welcome to another retirecoast.com YouTube video. In this video, we're going to discuss IRS Form 1040 SR, which is the U.S. tax return for seniors for the year 2022. You'll be completing this form in 2023 for the previous tax year. Please look at our website and our blog article on this topic, retirecoast.com. You'll want to read further. We have lots of places where you can go and get more information as a result of our article, including links to the IRS on various other forms and instructions that you may need beyond what we talk about in the article and in this video. So please listen to the video. This may help you understand the form and complete the form, but please go to our blog site and read the article. It has far more information in it. Now, this form was created for seniors by the Internal Revenue Service just a couple of years ago as a result of all of the tax changes that took place in 2017. Now, you may remember there was a lot of activity regarding those tax changes. Some people claimed the next year when they filed that they weren't getting as much money back. The fact is that they were getting more money back because they were paying less in during the year. Now, I discussed that completely in the article in which this video is placed. You can read about it up above. But I want to go through the form now, and even though we explain it in our article, I want to show you visually so you can listen. Maybe this is easier for some people than reading the article, for example, and reading the instructions. We're going to start by clicking. We have an example here of Sally Jones and Paul Jones, who are both seniors and they're both retired. They have checked married filed jointly right here where my finger is, and you can check any one of the other boxes if they apply to you if you're single or head of the household. If you don't know what these things mean, you can find out by going to our website and then clicking on one of the references to the IRS where you can read more about it. But for most people, they're going to be single or they're going to be married filed jointly. You put the names here where they belong. You put the Social Security numbers here, and it's very important that you get those correct because that's what the IRS uses to track everything. Then your address and your city, state, and zip, very simple. If you have been involved with activities from a foreign nation, for example, you have a bank account in another country, you need to complete these, and then you're going to be asked for additional information later on. In fact, this may not even be the form for you if you have complicated and complex tax issues. You can choose to use this form if you are qualified, which is 65 or older, or you can use the standard 1040 form. It's your choice. This is a better form for seniors, and we're going to go through it, and I'm going to show you why. So we've checked the presidential election campaign here for both. It's important that you understand that the $3 it talks about here is not coming out of any refund you might get. It actually just directs the government to take $3 from the amount you paid in and your spouse paid in and donate it to the presidential election campaign. And just as an aside on that, it's really to try and reduce the amount of private money that goes into the fund so that it makes the election a little more fair. I'm not going to get into more details than that. You make that decision on your own. The digital assets is something new that they've added this year. The IRS and the government in general is trying to get some control over all of this digital currency. Cryptocurrency is a term that comes to mind. Bitcoin, any of those other kinds. They want to know if you have this as an asset or not. And then if you do, you need to read the instructions. There will be some more information about that. Most people won't have that. Some people do. If they do, check it and then look into it. The standard deduction is what you get, so you are not checking anything right here if that's what you want, unless you have some different type of tax needs. For example, you are a dependent, or your spouse is a dependent, or your spouse itemizes on a separate return, or you're a dual status alien. Most people won't be using these blocks here, but you will be using these two blocks right here for you and your spouse if you're filing a joint return as Sally and Paul are. If you're filing a single return, it's just one block and you don't fill this one in. Now this looks a little bit strange to me. Age and blindness here. They're trying to combine the two, I think, to save space. But basically, if you're blind, then you check that box, and if your spouse is blind, check that box. But you need to check these boxes here to get the standard deduction. The whole point of using this senior return is not to itemize, which is a separate schedule, and that you use that with the standard 1040 form. So we're going to go forward with the, the standard deduction. I'm not going to list any dependents in here. This gets a little bit difficult. For most seniors at age 65, they are not going to have dependents unless that dependent, in some cases, may be a parent, in which case you can complete this information with Social Security number in relationship to you, and then you should know that you can't deduct that person and have that person file a tax return. So basically, if you put the name on here, the person whose name you put on there cannot be filing their own tax return, and you need to provide about 51% of the support for the people whose names that you enter in here. If you need to put some information, then go to the instructions. We have a link there to the IRS to learn more information about using these blocks. Most seniors will not be using those blocks. The total amount from the W-2 forms, I'm not going to show you. All these blocks are empty right here because if you are a retired senior, it's unlikely that you'll have any information to enter. If you do, then simply put the information in. That'll come from a form that your provider, that wherever you receive the funds, should be giving you that form. For in this case, it'd be a W-2 form. Now, some seniors are working and they will get a W-2 form. In that case, you put that information on here, and you can always go back and see more instructions about that. But I put 0 on here because the Joneses aren't employed anywhere. They are retired. And then we're going to come down here to this section from 2A, 2B, and these sections right in here. Now, if you have tax-exempt interest, you can put this in here, and then they're going to want to know how much that is. That tax-exempt interest might be from municipal bonds. You will be getting some paperwork from the provider there. Now you have to attach Schedule B if those amounts exceed $1,500. We're not going to put anything into these under qualified dividends either, or ordinary dividends. What we are going to do is put in $1,000 for IRA $10,000 for IRA distribution, and the taxable amount of that is $10,000. Now, there are some occasions when, for example, the amount that you take is not fully taxable. I'm not going to give you any of those now, but basically this $10,000 is fully taxable. Let me pop back up to ordinary dividends. Normally, I would have entered something in here because many people have stocks and they have dividends that are paid out. Now, even if you have those dividends reinvested, you still must claim them as income in the year in which those dividends were paid. So I should have probably put something in here just to make sure that you covered that. Pensions and annuities, so this couple has $5,000 in pensions, but only $300 of it is taxable. Many pensions are like that, where only a portion of it's taxable. Social Security benefits, they were paid $38,000 by the Social Security Administration, and the taxable amount on that is $16,000. And you achieve that taxable amount by taking a look at the other form I'm going to get into in just a moment, where you put the information in here. And it doesn't say that here, but that's how it works. So if you elect a lump sum election, we have left that alone. And then there's capital gain or loss, Schedule D, and we put down $1,000. Now, you don't need to attach the Schedule D if it's less than $1,500, so that's why we entered $1,000 there. So now we have $10,000, $316,000, and $10,000 here. We don't have anything in Schedule 1. Now, Schedule 1 is a listing of all kinds of income sources for different things. And you can go and take a look at Schedule 1. Most people won't be using it, so we put 0 here. And then we added up all these lines ahead of before you. See, all of these here are then added right in here. It comes down to 27,300. Then we're going to drop this down here to 27,300 because we have 0 in here. No reason to enter zeros. You can. I've entered a couple of them here. The standard deduction is the amount that you enter here, which the government will give to you. And I'm going to pop down here and show you what that is. They ask you to take a look at your filing status. So we're married, filing jointly here, and there are 2 people right here. So we're going to go right over here to $28,700 as the amount that's put in. And here it is, $28,700, which is the standard deduction. Now let me explain the standard deduction to you very quickly. When the tax information was changed in 2017, when Congress made all those changes, they, for the most part, doubled or even greater than that the amount of the standard deduction. And the idea was that you no longer had to do that long list of itemized and figure out how much you were going to deduct for, Little League and tools and etc. They made it easier, and they said, we're just going to give this big standard deduction and make it simple. And that means that most people will no longer have to file a long form. In the case here, that the Joneses aren't filing the long form, they're taking the standard 28,700, which, by the way, is higher than most people get. The seniors get a bump on top, so this includes the senior edition. If you are under 65, you'll get a lower standard deduction. It's not much lower, but it is lower. Then we're going to take this down to the same. We're going to drop this number down here since we have 0 here, and then we end up with 0 taxes, because this number, the standard deduction, is higher than the adjusted gross income. Again, another great reason to have the standard deduction. You should read the article about all kinds of things that you might otherwise want to deduct, such as your state income taxes and your property tax and interest on your house. All of those things, there are limits for you, and if you are in a high tax state, those limits will prevent you in many cases from actually exceeding the standard deduction. If you were to start and do the itemized deduction, you probably won't reach the 28,700. In a state such as Mississippi, where I live, most people can't reach the 28,700 because property taxes are lower, the interest that they pay on their mortgage is lower, and they just can't get there, which is actually good because it takes less time to fill out this form. So this one shows basically 0 taxes. Now, there's nothing on in any of these categories here to deal with. This goes back to the other schedules, tax credits and things most seniors do not have. Now, there are some you can get for child care, for example. If you're taking care of a child, a family member's child, for example, and other dependents, you might be able to get some credits. But most seniors won't have those. So we put 0 in here. Now we get down here and we have payments made. Now you won't probably have anything to enter in these payments made, but I will caution you on this. If you took a distribution from an IRA account, for example, They may have paid some taxes for you, and if that's the case, then you need to look at this 1099 form here and put down the amount of taxes that they paid the IRS. If you had a small income, for example, you want to put those taxes right here from the W-2 form. Then you'll have to go back in and make a change up above as well. But don't ignore these unless you have no other payments that you've made to the IRS or any credits that you qualify for. There are some credits here which aren't payments, but the IRS essentially is giving you money back or credit against your taxes that are due. Now, we're going to come over here now, and you don't have a refund because you didn't pay any taxes in. But if you did have a refund coming in, for example, if you paid $500 out of that distribution that we showed you from the IRA, and you paid that to the IRS, since you owe zero taxes, the IRS would have to pay that $500 back to you, in which case you would be getting a refund. And then you'll fill in the information on how they can pay you back by direct deposit. Okay? And if you had somebody else do your tax return, this would be the information in here. Otherwise, you will date and sign this return, and you can mail this in, or you can file your return online. And there's information about that in our article. Also, you can check on the status of a refund if you have one, again by going to our site. Now, the next thing I want to talk about is I want to go back to this Social Security adjustment right here so that you understand how these numbers came from 38,000 to 16,000. As I mentioned, we were going to go through the Social Security benefits worksheet, which you can see in front of you here. We're going to start out at the $38,000, which you saw on the 1040 form. That was entered as the total amount that was earned by this couple. And then they want you to multiply it by 50%. That puts it down to $19,000. Then they want you to combine the amounts from the lines, from all these lines right here, which we are bringing down from the 1040 form. And then they want you to combine these two together. So I'm not going to go through all this math here because frankly I don't understand why they do all of this, and they don't explain it at all. It's some mystery. But you come down to $30,300. Okay. Then it says here, if you're married filing jointly, you have a $32,000 exemption, basically. In other words, you won't pay taxes on up to $32,000 of Social Security benefits. Then we come down here, we end up with 0 here because this number is bigger than this number. And then we go through all kinds of little numbers down here, just basically enter the information and do the math as it says. And we come down with $16,000. These are taxable Social Security benefits, okay? Basically, it's, 85% is essentially taxable. So you're going to pay tax on money that you've already paid taxes on. It makes no sense. If you go back years and years, there were 0 taxes on Social Security income, and then Congress changed it and they increased it to about 50%, and now it's up to 85%. So that's nearly all of the amount that you get is essentially taxable. And what saves you here is that standard deduction or other deductions that you might have if you use the long form. Nevertheless, you are going to pay taxes if you earn too much Social Security. Now, going back to that, most people the couples don't earn up to $38,000, so they probably wouldn't pay taxes on it even if they didn't have enough deductions. But the point is, you can earn a lot more than that if you have maxed out your earnings in Social Security. You could earn up to over $3,000 per person. That's a much higher number, which means you'll be paying quite a bit in taxes if you don't have commensurate deductions. back to the 1040 SR form. We just talked about the Social Security benefits. Now here's the numbers that we started with, just to bring you up to date, the $16,000. And then we went through the entire process here to find out that this couple owed 0 taxes. Now this is pretty close right here, 27,300 and 28,700. If this number here, the gross, had been, say, $30,000, then taxes would be owed. And that would be the difference between $30,000 and $28,700, for example. So this couple were lucky in one sense that they don't owe taxes. Of course, they may say that they'd like to make a lot more money, in which case they'd pay taxes. But let me explain something else to you before I close on this particular topic right here. When we go to IRA distributions, this is $10,000 here. It could easily be 20 or 30 or 40 or 50,000 or more, depending on your circumstances. You may have put a lot of money into your 401k and then rolled it over to an IRA. If you take out too much money in a year, and I mean too much, if they had taken out just another $1,000 or $1,500, they would have broken even. But if they'd taken out 20,000, for example, not 10, they would owe federal income taxes. Now, there's a strategy to making sure that you pay the least amount of taxes by trying to stretch the amount that you take out every year. In this case, if they had done some tax planning, they could have taken out a little more in IRA distributions to make that an absolute break even, and then take that out every single year. You'll be doing two things. One, there's a mandatory deduction at age 70 and a half, and you'll be meeting that without any problem. The other way, you'll be getting all of that money out of that taxable IRA account without paying taxes if you take it out every year. Take the maximum amount that you can every year. Now, you don't have to spend that money. You can roll that money over to a Roth IRA, and then you can do exactly what you were doing with the IRA before, buying stocks, bonds, mutual funds, and do other kinds of investments. And on that account, you will never pay taxes again on the income that you've earned. So this is just a little bit of strategy. The article doesn't go into this very deep. We have many other articles on our website that do cover this, so please go to retirecoast.com and check out our other articles. Thank you.